On January 3, 2026, U.S. Special Forces captured Venezuela's president in Caracas. Within hours, the Trump administration announced that they would temporarily run the country to rebuild the oil infrastructure and get the oil flowing. The keywords to me here are oil infrastructure. And in today's video, that's what we're going to focus on. We're not talking politics. Doesn't matter if you agree or don't agree with the move. What we are going to do is break down why this is important to us as traders. Venezuela sits on more than 303 billion barrels of oil. That's more than Saudi Arabia, so there's a massive reserve there waiting to be unlocked, but there's also the potential of getting Venezuela back up to its production potential compared to where it's currently producing in terms of barrels per day. I'll show you some charts which helps illustrate that point in just a second. But that's the entire focus of today's video, the reconstruction trade. I'll share the specific companies that I think are likely to benefit from this entire rebuild process, and we'll bring together the macro narrative that we're going to talk about in PowerPoint slides here with ThinkOrSwim charts, taking a look at technicals to see where do we actually have entries and where can we take advantage of these trades. Now, one thing I want to emphasize, we're focusing on the reconstruction efforts here, and there's four key themes or four segments and players that we'll talk about. There's also the downstream effect that you will have if and when this plan comes to fruition, where you do now have cheaper crude in the marketplace. And I can make a part 2 if there's more interest, which focuses more on that downstream effect. In this video, we're focusing on the reconstruction trade. Now let's start with first taking a look at what is the opportunity in Venezuela here. And there's two charts which help prove this picture. The first is this chart on the left. That shows you what are the oil reserves, and you should notice that Venezuela leads the way in the entire world. It's ranked first. It has more than 303 billion barrels. That's more than Saudi Arabia at 267, more than Canada at 163 billion barrels. However, when you take a look at their production, Venezuela is well below not only its own production potential, which in the early 2000s was close to 3.5 million barrels per day. Currently, it's at less than 1 million barrels per day, and that delta of 2.5 million barrels is what we're looking to add to the global supply when we talk about that downstream effect. With its current production at less than 1 million barrels per day, Venezuela is currently ranked 25th, and this gap, this slip, exists because of decades of mismanagement, sanctions, ignoring basic maintenance, and an overall infrastructure collapse, which needs to now be rebuilt. However, to rebuild this, there's a proven playbook. There's a proven playbook of players that these contracts are given to. Those are the companies we'll talk about in this video. And they also have decades of experience operating in regions like Iraq, Kuwait, Angola, and Libya, each of which I think lends to the experience of why they are likely to be given the same contracts here in Venezuela. Now, there's four themes that we'll break down in more detail. The first is the majors who will operate the fields. The next are the service companies who will restart the wells. The third are the contractors who will rebuild the actual infrastructure. And fourth are the refiners who will take Venezuela's heavy crude and process it and turn it into something a little bit more useful. So let's start first with the majors. So who gets the call first when a major oil producing nation needs to be brought back online? Well, instead of guessing, we can look at history. And one thing that stands out is Iraq. And if we study Iraq in a little bit more detail, March 2003 is when the invasion begins. By 2010, ExxonMobil is operating one of the largest oil fields in the region. That to me says they have experience getting their infrastructure up and running through periods of chaos. And Iraq isn't the only time they've done this. If you take a look at Angola from 1975 to 2002, Angola was in the middle of a 27-year civil war. And during that entire time, ExxonMobil continues to keep producing. They pulled out 2.7 billion barrels of oil from Block 15 while the country was literally at war. And they did it again in Libya. As soon as the sanctions were lifted in 2004, Exxon was one of the first companies back in, ready to start drilling. So that tells me that ExxonMobil has experience operating through periods of chaos, and I think that experience is going to be something beneficial for why they might be given these contracts for Venezuela. The second company that I think is likely to benefit here is Chevron. Chevron has unique partnerships inside of Venezuela, given that they're already embedded inside and were all the way up until now last year, 2025. They were the only U.S. major who held an active operating license operating inside of Venezuela. They had partnerships and relationships with PDVSA. That tells me that they have institutional knowledge ready to go. They already have pre-built infrastructure. They know the fields, they know the people, and they know how things work on the ground, given that they were operating in the region all the way up until 2025. And if you want proof that Chevron too can operate through complex long-term projects, take a look at Kazakhstan. They have this project there called Tengiz, which is a mega project. It's been operating since 1993. That's 30 plus years of continuous development in this challenging political environment. So again, similar to ExxonMobil, they have experience operating through difficult tension periods, and they have experience surviving and thriving through those periods. So XOM and CVX are the two stocks that stand out here. These stocks benefit from production volume growth even if crude goes down, which means they really are not sensitive to oil when we talk about them with this particular regard. Now, before we move on to theme 2, let's take a look at the ThinkOrSwim charts here. And we'll start with ExxonMobil. ExxonMobil currently has already hit its 1272 extension, and the next level we have is the golden ratio at 150, 150.85 to be exact. If you also take a look at all of these bullish signals, that would suggest we should see shorter term gain inside of ExxonMobil. If you take a look at some past activity here, 2003 is where the invasion inside of Iraq began. By 2010 is where ExxonMobil had been operating West Querna successfully. You can see the appreciation from 03 to 2010, and you can see what happens after 2010 as well. Currently, the levels above us are 150.85. CVX, if you take a look at, CVX looks like we're still chopping down, and we're starting to see that first histogram bar give us the initial signs of the squeeze reversing. In both ExxonMobil and CVX, we have a squeeze. However, I think it's, at least in ExxonMobil, I would need to see a little bit more of a pause before I can take an entry. CVX, on the other hand, looks like we might get that entry below 130, which I think would be resistance turned into new support, and support all of these bearish signals that we're seeing. Let them play out. Let that overbought activity play itself out. Get a better entry to play the move inside of Chevron and leverage their existing relationships in Venezuela. I imagine both of these would take some time, not happen overnight, but they are things that I want to have in the back of my mind. Now, the majors alone can't restart production without the companies that actually do work on the ground. Here's where Schlumberger has a massive advantage. Right now, sitting in Venezuela, there are 15 Schlumberger drilling rigs, and they look just like this one, mothballed. They're waiting, and that's the largest inventory of U.S. oil field equipment already in the country. So if you think about what that means, when production does in fact restart, Schlumberger doesn't need to ship rigs across the oceans. They don't need to deal with customs. They don't need to navigate logistics in a country with broken infrastructure. Instead, all they need to do is simply just flip on a switch and start drilling, given that they already have these rigs in place. That's weeks, maybe months of lead time that they have over their competitors. And that's why I think Schlumberger is in this unique position to have this immediate operational advantage. They eliminate a lot of the logistical hurdles that their competitors will need to experience. Now, speaking of competitors, if you did have to bet on one, I think Halliburton is a good choice. The reason is they literally wrote the playbook on the same conflict, similar to ExxonMobil. If you take a look at 2003 and you go back to Iraq, the infrastructure is destroyed, oil fields are on fire, the US government needs someone who can rebuild an entire nation's oil sector from scratch. Halliburton is the one that is awarded the contract through their subsidiary KBR, and this is a $2.26 billion no-bid contract called Restore Iraqi Oil. That initial contract turned into a decade-long engagement. So if you think about that, they proved themselves to now secure more than 10 plus years, more than $39.5 billion that they got from this particular engagement. Halliburton handled everything from putting out well fires, fixing infrastructure, restarting production, and building the logistical network. That means that if there are two companies that you'd want to bet on, I think these are the two that stand out to me. Schlumberger has the immediate operational advantage, and Halliburton has the experiential advantage, given that they've done this before. Now, if we take a look at each of these two stocks, we can come into Schlumberger first here. Schlumberger on the weekly, that trend has just switched. So to me, you're getting a much better entry than many of these other stocks that we're talking about, not just in this video, but in previous videos as well. Schlumberger feels like we have a macro narrative along with a nice edge. The market pulse has just transitioned from this long period of bearish activity stemming from the beginning of 2024. We had 2024 go, we had 2025 go. We're now at the beginning of 2026 entering with the market pulse having turned green. So I think Schlumberger stands out here. And if you take a look at Halliburton, similarly, Halliburton's trend has also transitioned. Halliburton does not have a squeeze versus Schlumberger still very much has a squeeze, which I think leads to the upside potential that we have here. I would be aiming for previous highs, which are near 60 inside of Schlumberger, and I think that's the better of the two if you had to choose one, given that they have this ready to go on the ground advantage, and now they have the catalyst in play. Again, I think there will be some lead time, so in terms of the actual stock pick, if you can get a pullback to the actual market pulse line, I think that would be ideal, and you also have upcoming earnings on January 23rd. Next up, we have the EPCs. EPC stands for Engineering, Procurement, and Construction. And these companies are important because they are going to be key in rebuilding Venezuela's infrastructure. We're talking about pipelines that haven't been maintained in decades, refineries that are barely operational, ports that can't handle modern tankers, and power grids that can't support industrial operations. Rebuilding all of this requires engineering and project management at scale, and there's only a handful of companies that can do this. I found two in my research. One is FLOR, and the other is this company called Bechtel. Bechtel is not tradable, so I ignored it. It's an over-the-counter sort of stock, but FLR is a little bit more liquid. So I did a little bit more of a deep dive into FLR. Now, I think there's a bit of time before we're interested in this particular stock, but Fluor, just like ExxonMobil and the themes we've been talking about, demonstrated operational experience in the post-Iraq invasion. When the country needed its electrical grid rebuilt, Fluor managed 70 million work hours without a single lost time incident. That to me demonstrates their experience and operational discipline in a war zone slash chaotic environment. They've been doing this for more than 75 years. They rebuilt Kuwait's Al Zour refinery. They've been operating in the Middle East since the 1940s, and they have experience working through this post-conflict environment. If you take a look at the stock chart of Fluor, there's two key things that stand out to me. One is these overbought confirmation signals, and two is this recent trend switching to bearish. I think we're likely to see below 30, and the time where I imagine you'd want to get interested or excited about investing in Fluor is maybe when Fluor starts to announce some moves in Latin American infrastructure, something about these contracts, or maybe something about longer duration, high margin projects. That's where that might be your code words or clues that Fluor has been given this contract and we want to start to get involved in this particular theme or segment. And now we move on to the last theme. And this is where I think things get a little bit more interesting because we talk about the technical constraints that exist in this particular opportunity with Venezuela. The constraints around Venezuelan oil. Venezuela's oil is not like that of West Texas Intermediate or Brent. It's heavy and sour, and it requires heavy and specialized equipment to process this and turn it into something that is useful. The way we do this is through a machine called cokers, and you'll notice as we talk about these companies, something we refer to as their coking capacity, and that's the capacity of these machines. In fact, before we talk about the key players, let me break down what coking capacity means and what cokers are. It's not what you might be thinking when you think about Venezuela. Cokers are essentially massive pressure cookers. They break down heavy crude into lighter products. They're expensive to build, hundreds of millions of dollars, and only a handful of Gulf Coast refiners have invested in this capacity to handle Venezuelan oil at scale. If you take a look at some of the companies that have made some of these recent strategic investments, The first is Valero, who completed a major expansion at Port Arthur, adding a 55,000 barrel per day coker. The second is Marathon Petroleum. Their Garyville refinery contains major coking units, which are capable of handling the heavy crude imports from Venezuela and processing them into something a little bit more useful, like gasoline and diesel, that we can use. And finally, you have Phillips 66, where their Lake Charles refinery's production of petroleum coke, which is a byproduct of these cokers, indirectly reflects their substantial coking capabilities. So now we come back to our previous slide and we can take a look at our Gulf Coast refiners, look at those same players, and I'll add one more in here, which is PBF Energy. Now, one more time, if we discuss Valero, Valero is the biggest. In 2024, they processed 44% of all Venezuelan imports. To me, that signals nearly close to half of the imports. And this major expansion at their Port Arthur refinery that we just talked about, I think, isn't just coincidental timing, but rather something they might have been preparing for and makes them best suited for this opportunity and to benefit from it. Next up, we have PBF Energy. They also have a facility in Louisiana that was literally built to process Venezuelan crude. They accounted for 14% of Venezuelan imports. And if you take a look between these two, you have almost 60% of the imports here. And I think that suits them up as well to be a key player in this entire refining process. Finally, you have the two other players that we talked about who have coking facilities, which I think makes them also likely benefactors of this refining capacity as we start to increase the production potential of Venezuela. If we come into ThinkOrSwim charts and we start with Valero, we have upcoming earnings, we have a squeeze that's building up, we have most recently an overbought confirmation signal, an entry near 155.81 feels like a nice entry for a way to participate in any kind of upside here, at least shorter term upside. If you contrast this with PBF, PBF looks a little bit interesting in that we have the same trend switch here, but we're not near all-time high. So you might argue that you have a little bit more room for upside here. Similar to Valero, we have a new squeeze that's forming, we have a recent overbought confirmation signal, and we have upcoming earnings. If you take a look at the other two players we talked about, we have Phillips 66. While we do have this trend that's intact, feels like we have a lot of overlapping candles here, and I would be looking for a little bit more downside in PSX. And Marathon Petroleum, if you take a look, you saw the overbought push already happen here. If we can get a push below this previous low, maybe a gap fill near 151, that would suggest an entry in this choppy region and one in which you now have a narrative to support the overall idea for this gap fill and then the squeeze to slingshot back up into earnings. So I think each of these refiners offers some interesting stock plays, but the upcoming earnings has me on a bit of pause. The clear winners that I think here are Valero and PBF, given that they are already handling crude imports, and between the two of them handle almost 60% of them. So finally, if we now bring everything together into some form of an informal scorecard here, you can see just how many of these companies have had experience operating in post-conflict regions as well as operating through conflicts. ExxonMobil, Chevron up at the list, Halliburton, Schlumberger also up there at the list, and we just talked about Fluor, which also had experience operating in Iraq and Kuwait. However, between all of these companies here, I think they're all suited to have some form of participation in this entire rebuild process. They have some small slice in one of these four themes, and that's where I think you can benefit from at least being aware of them from the get-go. Some of them are a little bit more downstream in this entire funnel of where they participate in this overall process. The first ones we talked about were ExxonMobil and Chevron. But we talked about some of these nice setups. One of those was in SLB. There's a lot of these interesting stock plays as well where you can combine the technicals with the macro narrative to ride some of these trends before the news even hits the market, knowing what's coming down the stream. Take care, everyone. I hope you found this video helpful for a way to bring together what recently happened over the weekend with some stock charts and some actual stock picks, leaving politics on the sidelines. Take care, everyone. Good luck trading, and I'll see you in our next update.